Warning: if you believe the government creates real wealth through laws, regulations, and policy, that politics is the key to investing, or if you're looking for some sort of scary, the sky is falling presentation about extreme valuations in the US stock market, if you're looking for someone to peddle fear about the US dollar losing its status as the global reserve currency, the risk of runaway inflation, the next bubble, crash, or crisis, or even America's massive government and consumer debt, then I certainly do not want to offend you, and I must warn you that this presentation probably just isn't for you. So I'd advise you to just click away right now. Hi, my name is Elliot Gu. In the next few minutes, I'm going to show you an urgent video presentation I recently gave to a small, select group of investors concerning the recent rally in the S&P 500 to fresh all-time highs and the recent improvement in US economic data. Specifically, watch this video through to the end, and I'll explain why I believe you should ignore the hype about the Trump administration's recent trade policies, the mainstream media's sensationalism surrounding the upcoming midterm elections, and even the likely inversion of the US yield curve starting next year. I'll explain why I believe the recent rally is only the beginning of a more meaningful surge for the stock market that will see the S&P 500 jump at least an additional 10% by the middle of next year, and why all the ridiculous hype and fake news in the mainstream and financial media could cost many investors some serious cash. Why I'm so worried that individual investors will be buying precisely the wrong stocks and ETFs. And perhaps most important of all, I'll explain some of the specific profit steps I'm recommending right now to potentially take advantage of the shifts already underway in global economies and markets, and how you can spot the real warning signs when it's time to sell stocks and take steps to protect your portfolio ahead of the next bear market cycle. However, before I get into all of that, I should probably step back for a minute and introduce myself. As I said, my name is Elliot Gu, and you may or may not have heard of me or my firm. Over the last 20 years, I've made my career using powerful yet predictable market cycles to forecast major trends in stocks, commodities like oil, corn, and gold, even interest rates, emerging markets, and the US economy. 13 years ago, in a book published by Prentice Hall called The Silk Road to Riches, my co-authors and I correctly predicted a surge in energy demand from China, and India would overwhelm global supply, driving an unprecedented bull market in oil prices and tremendous gains for energy investors. And using my research on agricultural cycles going back to 18th century England, I called a tipping point in global demand for meat that propelled the prices of key feed commodities like corn and soybeans to record highs back in 2012. A move that produced gains of 763% in fertilizer producer Potash Corporation, 94% in oilseed processor Bunge, and 296.4% in an under-the-radar palm oil producer based in Belgium. In late 2008 and early 2009, while many talking heads in the financial media were calling for a second Great Depression, I even called the bottom in global stock markets and recommended loading up on names like consumer finance firm Discover Financial, up 582.8% since the end of 2008 alone. Railroad giant Union Pacific, up 387.1%, and even home improvement giant Home Depot, up 345.6%. Just last year, on May 24th, 2017, my research on the manufacturing cycle led me to recommend an odd industrial company overlooked by so many on Wall Street that's since surged more than 50%. Even more recently, back on February 25th of this year, I used the very same powerful cycle indicators I'll explain in this presentation to advise my readers to buy the big sell-off in the stock market and to buy regional bank SVB Financial, up 28.61% since late February alone. Or you may or may not have heard of the work we've done helping investors avoid the pain associated with the collapse in oil prices and disastrous declines in many energy stocks and master limited partnerships since the summer of 2014. 4 years ago, with oil near $100 a barrel, Some pundits scoffed when we caused for oil prices to eventually break down to $30 or lower. However, the critics were silenced when our timely sell calls and popular energy high flyers, such as deepwater driller Seadrill, proppant sand manufacturer High Crush Partners, and upstream partnership Lin Energy, helped our readers avoid declines of 90% or more and the elimination of dividends and distribution income. All of these buy and sell calls, and so many more, are a matter of public record through numerous appearances I've had on CNBC, Bloomberg Television, radio shows all over the US and Canada, reference in articles appearing on Seeking Alpha, MarketWatch, and Barron's, through investment research services I've founded, or my 2 investment books. However, that's not why I created this letter today. I certainly have no desire to boast or brag. I reference our success and experience calling some of the biggest cycles and trends in global markets because my research confirms that some of the most powerful cycles we've followed for decades will converge over the next 12 to 18 months. I'm not exaggerating when I tell you this will mark one of the biggest money-making opportunities of my entire career. However, I'd also be remiss if I didn't warn you that it's one of the most dangerous stages of the economic and market cycle. To make matters worse, many investors are making a crucial mistake right now that could devastate long-term returns, threaten retirement goals, and income potential. A mistake I believe is compounded by all the sensationalist noise and in fact downright lies discussed daily in the mainstream and financial news media. I urge you to keep listening through to the end, as I believe this could be one of the most important and most profitable presentations you hear this year. As I've said, just a few days ago, I hosted an online presentation for a small group of investors where I explained in the simplest terms possible the exact cycle indicators I've used to make most of the market, economic, and stock-specific calls I just mentioned. It's far too important to just hide this presentation behind a paywall. So today, as part of this presentation and only through this website, I'm going to release a portion of that presentation video to the public free of charge. I promise I won't waste your time. Keep watching this presentation through to the end, and you'll also discover some of the specific and time-sensitive profit steps I'm recommending right now. So without any further introduction, here's my latest video presentation on the economy and stock market. First of all, we've been hearing a lot about the length of the current bull market. A couple of weeks ago on, I believe it was Wednesday, August 23rd, this bull market, as measured by the length of the rally in the stock market without a 20% or greater correction in the S&P 500. So in other words, the S&P 500 has seen corrections, in fact, one correction of around 19% in late 2015, early 2016. But the sort of unofficial definition of a bear market is a 20% or greater correction. And the current rally is the longest in history, the longest in US stock market history, uninterrupted by a 20% or greater correction. We've seen the rally last 3,475 days as of today, September 13th. So it's the longest rally in history. On August 23rd, it surpassed the rally of the 1990s from October 1990 up through March 2000 in terms of length. And I've put a number of the historic rallies in the stock market, the longest historic rallies in the stock market going back to the 1930s. And you can see that this rally and the rally from 1990 to 2000 are head and shoulders longer than any prior rally we'd seen in the S&P 500. So there you have it. The US stock market is very expensive right now. In fact, it's more expensive than it has been in 97.7% of all months since January of 1881. And I know there's been a steady drumbeat of dire predictions coming out of Wall Street in recent weeks, including several calls for a recession by 2020, and all the talk about the current rally being long in the tooth or overextended. However, my extensive research into economic cycles confirms that cycles do not die of old age. Indicators like the US Leading Economic Index and market breadth historically give plenty of warning of danger ahead long before the stock market tops out and enters a new bear market. Simply put, a bear market is coming. But the indicators I watch strongly suggest there will be a significant rally, a melt-up move in the stock market before that peak. And I can't stress this enough. Missing out on the final 1 to 2 years of a stock market rally can be very expensive. In fact, if you miss the final speculative phase of a bull market cycle, you are almost guaranteed to underperform the market over the long haul. Of course, the most important thing isn't what's happening to the stock market and economy right now, but what you can do to profit from the changes underway and protect yourself from the eventual bear market cycle. And that brings me to a few simple profit steps I'm recommending right now. Profit step number 1, an early warning system for the next bear market. On Wednesday, August 22nd, the bull market turned 3,453 days old, officially surpassing the historic rally of the 1990s to become the longest in U.S. financial history. From its lows in March 2009, the S&P 500 has soared 412.7%. And, as I mentioned earlier, reliable valuation metrics like Professor Shiller's cyclically adjusted price-to-earnings ratio suggest stocks are more expensive today than they were at the highs back in 1929. Warning, the average U.S. bear market since 1937 has wiped out 35.5% of the value of the S&P 500 over an average of just 13.8 months. And the past 2 bear market cycles, starting in 2000 and 2007, have been far worse, resulting in average declines of more than 50%. And with the market valuations as high as they are today, the next bear markets could be yet another doozy. Yet the big conundrum for individual investors is this. As I've explained, the penalty for selling out of stocks too early is very high because the S&P 500 has soared an average of 25% in the final year of a bull market and 58% in the final 24 months. That's why I'm not exaggerating when I say that the first and most important step in your investing process must be to develop a reliable system for monitoring the health of the economic and market cycle. And that's why I've developed the Deep Dive Investing 10-point bear market checklist. Listen, there are literally hundreds of economic data points released by the US government, various industry organizations, and private companies every single week of the year. Well, I've spent more than 20 years studying the US and global economies, and I must warn you that some of the economic indicators widely quoted by the so-called experts in the mainstream media are actually backward-looking and tell you very little about what's ahead. Watching those lagging indicators is about as effective as driving down the highway at 80 miles an hour, gazing intently in your rearview mirror. Meanwhile, other economic data points I hear talked about endlessly by some pundits are just too noisy to be helpful. Using these indicators is about as productive as listening to static on the radio at full volume while trying to hear a symphony. Look, I developed the 10-point bear market checklist to provide a clear, reliable indicator of the health of the economic and market cycle. Follow these indicators, and it can help you avoid the next bear market cycle and take real action to protect your portfolio before it's too late. The best part of all of this is that these indicators are nothing fancy. Like the Conference Board's Leading Economic Index and the NYSE Advanced Decline Line that I showed you earlier in this presentation, all of the components of my checklist are simple, unambiguous indicators that you can follow for free as long as you have access to the internet. As I mentioned, I don't have time in this letter to outline all the components of my bear market checklist and what it tells me about the health of the market and the economy today. However, I'd like to give you access to a detailed 90-minute online presentation I've created that outlines all 10 components of the checklist, plus how and why I use each indicator. This presentation comes with a quick read executive summary and a detailed 42-page presentation slide deck that includes all you need to know to start profiting from our bear market checklist immediately. The best part of all is that for a limited time, I'm offering access to this crucial information, plus the latest readings on my bear market checklist indicators with absolutely no risk or obligation, only through this website. I believe my 10-point bear market checklist will help cut through all the noise and confusion of our 24-hour financial news cycle to determine where we are in the market and economic cycle right now. However, before I explain how you can access this presentation, I want to tell you about one simple characteristic shared by many of the top performing stocks at this stage of the economic and market cycle. And that brings me to profit step number 2. Late in the market cycle, buy stocks with this characteristic. Last year, S&P 500 volatility sunk to the lowest levels since the mid-1960s. However, that low volatility environment shattered in January and February when the S&P 500 experienced its worst pullback in 2 years. I must warn you, history shows that the January-February spike is just the beginning. In the final stages of a bull market, the frequency and severity of market corrections increases. So you're probably wondering, what do you do when market volatility picks up? As it turns out, there is one single characteristic common to many of the best performing stocks late in the market cycle as market volatility rises. Buy quality. Let me explain. In the stock market, quality stocks are those that show consistent profitability over time. And common metrics for assessing quality include return on equity and return on assets. Return on equity, for example, is calculated by dividing a company's net income by its shareholders' equity. The higher the ROE, the better the company's profitability. I recently completed a research project on quality stocks, and here's what I found. I assembled a hypothetical basket of stocks consisting of all stocks in the top 10 percentile of the S&P 500 ranked by 3-year average return on equity. I rebalanced that portfolio monthly and calculated the total return, which includes dividends and capital gains from this portfolio of high-quality stocks over a period stretching back more than 25 years. Over the final 2 years of the 2002 to 2007 bull market, this basket of high-quality stocks outperformed the broader S&P 500 by roughly a 7-point margin. And in the late 1990s bull market, returns from high-quality stocks were even more impressive. Total returns from this high-quality stock portfolio between the end of 1995 and March 2001, which was a year into that bear market, were actually 184.75%, which bested the S&P 500's 104.28% gain over the same time period by over 80%. That's pretty compelling, right? Of course, I never recommend blindly following simple quantitative screens like this. However, we run several screens like this on the market each week to develop lists of stocks worthy of further study. And over the past 9 months, our quality screen has helped us to identify some real gems, including a company that owns a treasure trove of data and data analytics that its customers must buy. In some cases, it's actually mandated that their customers buy this data by law. And this company derives a whopping 80% of its revenues from recurring subscriptions, and that stock is up 17.23% in less than 5 months. Another company in a unique niche of the healthcare industry with no exposure to drug pricing concerns, little to no exposure to expensive drug trial flops, zero exposure to insurance reimbursement, and no exposure to Medicare or Obamacare. And that stock is up 13.85% in less than 7 months. One of America's largest retailers that's a direct play on one of the biggest growth trends in the US today and may actually benefit from slowing new home sales. And that stock is up 28.52% since early December of last year. I'd like to give you immediate access to a 78-minute online presentation and training session that explains exactly how we assess quality in the stock market and how you can put this powerful characteristic to work for you starting immediately. Of course, this presentation comes with an information-packed slide deck and quick read executive summary available for download in convenient PDF format. Both are yours to keep. I'll show you how to get risk-free access today in just a few moments. However, first, that brings me to this, profit step number 3. In today's pay-nothing interest rate world, buy secret yields. The S&P 500 currently offers a yield of just 1.8%, and the 10-year US government bond yields less than 3%. In Europe and in Japan, many government bonds actually pay negative yields. That's right, investors are actually paying the German government interest for the privilege of loaning them money. Meanwhile, in the US, many so-called experts on Wall Street and in the mainstream financial media advise selling income-paying stocks right now because interest rates are on the rise. All the while, of course, many of these same talking heads are busy peddling low-yielding ETFs and target maturity retirement funds to individual investors. That means more fees for them and pathetic yields for you. However, Deep Dive Investing co-founder Roger Conrad has built his 30-plus year career helping individual investors identify low volatility ways of earning steady income from their portfolios in all sorts of interest rate environments. His system for identifying these low-risk income stocks helped him rank first out of more than 100 advisory services in long-term risk-adjusted returns by the Holbert Financial Digest. And his proprietary cash flow and risk models can also help you avoid what's arguably the biggest potential pitfall for income investors, a dividend-paying stock that's forced to cut its payout. Listen, Roger's research confirms that it's still possible to earn yields of 5%, 8%, or even 10% and higher, even in today's pay-nothing interest rate world. His secret? You must look beyond the handful of dividend-paying stocks the crowd focuses on and identify truly overlooked, under-the-radar gems. I'm talking about secret income investments like these. An obscure, odd little group of high-yield stocks that were very popular and very expensive just 3 years ago, but are now all but ignored by most investors. Amid the wreckage, Roger has found high-quality, low-risk yields of 6.6%, 6.3%, 7.6%, and even 8.4% today. A once sleepy pipeline company in Oklahoma that sits on top of one of America's most valuable shale reserves and offers a tax-advantaged 7.6% yield. A Canadian utility ignored by most US-based investors that currently pays an 8.8% yield. Don't worry, you can buy it right here in the US. A quirky little Maryland-based finance company that focuses on low-risk energy efficiency and renewable energy markets and pays you a 6.25% yield. Bonds issued by a small-cap Illinois-based communications firm due to mature in 2022 that currently offer a yield of 8.2%. Look, you may have never heard of most of these income investments. We call them secret because most receive scant research coverage by Wall Street analysts, and you're probably not going to hear about them on financial television. Few are significant holdings in any of the popular exchange-traded funds, including those funds that invest primarily in income-paying securities. In fact, that's why their yields are so attractive. You see, many of the popular usual suspect dividend-paying stocks are heavily owned by passively managed index funds and ETFs. Today, there is actually more than $164.1 billion invested in US ETFs focuses on dividend or yield-based investments. That's up 423.9% since September 2011 alone, and dividend-focused ETFs are only one small part of the much larger asset management market, which includes mutual funds and index funds targeting yield and dividends. All that money pouring into many of the exact same yield-paying stocks over the past few years has driven up valuations, and it's pushed yields sharply lower. In fact, the largest and the most popular dividend-focused ETF today, the Vanguard Dividend Appreciation Fund, now offers a yield of just 2.08%. That's pretty incredible, isn't it? The truth of it is that you want to earn yields of 5%, 7%, or even 10% and higher, you must look beyond these usual suspects, the large, well-known dividend-paying names that are widely held in these pay-nothing, quote, yield ETFs. That's exactly what my colleague Roger Conrad has been doing since the mid-1980s. And I want to reserve a copy of his latest report in your name, covering a list of his favorite high-yield investments to buy now. I'll show you how to reserve your copy of this report here in just a moment. However, first I promise to tell you about this. Profit step number 4. Trouble built on a subprime foundation. By all accounts, it's boom time for the U.S. auto industry. In 2017, automakers sold 17.25 million new vehicles in the U.S., even better than the pre-crisis sales peak of 16.98 million vehicles in 2005. And the auto business isn't just about sheer volume, it's about this. In July, 71.76% of all new passenger vehicles sold in the U.S. are sport utility vehicles and light trucks, not cars. That's a record high. And selling trucks and SUVs is certainly a lot more lucrative for the automakers than selling smaller cars. With these more expensive, higher margin SUVs and trucks accounting for nearly 3 of the 4 vehicles sold in America, average vehicle prices are soaring, reaching a record high of over $35,700 at the end of last year, up from less than $30,000 at the end of 2009. So let me ask you this. How are Americans buying all these expensive cars, trucks, and SUVs? The simple answer, easy auto credit. Over the past 2 years, about 30% of all cars sold in America were leased, not purchased outright. By leasing rather than purchasing cars, especially at today's rock-bottom rates, consumers can afford more car for a lower monthly payment. However, there's a dark side to leasing. While low-cost leases juice sales in the short run, the typical lease lasts 36 months. And when a car comes off lease, it's typically sold into the used car market. These lightly used, low-mileage off-lease vehicles often compete with new cars for buyers' attention. And here's the big problem. A record volume of lease cars over the past few years means a tidal wave of off-lease vehicles set to hit the market over the next few years. This year, 4.1 million vehicles are due to come off lease, well above the prior record of about 3.4 million at the prior peak back in 2003. Next year, the supply of off-lease vehicles increases a further 4.3 million. And by 2021, some projections show as many as 5 million additional cars, trucks, and SUVs coming off lease and hitting the market. But I'm here to tell you, this process and the damage it's causing to the industry is already well underway. I'd like to send you my detailed research presentation, including a quick read executive summary, explaining exactly how we see the coming auto crunch playing out, including one stock that actually benefits from the surge in used car and off-lease sales volumes over the next few years. Plus, we're monitoring a list of auto companies, auto parts suppliers, and consumer credit firms that we see as vulnerable to the coming tsunami of off-lease vehicles. We've developed a strategy to play the downside in these stocks as the current off-lease bubble finally bursts. I'll show you how to gain access to this detailed strategy session in just a few minutes. But first, let me tell you about a 5th profit trend we're recommending right now. Profit step number 5. To make money and earn hefty yields in real estate, think small and follow our checklist. Stephen Ross, Richard Lefrak, Ted Lerner, and of course, U.S. President Donald J. Trump are all among the world's billionaires who made their fortunes primarily through real estate. The good news, you don't need to be a billionaire to make serious money and earn impressive yields in real estate, thanks to the real estate investment trust structure created in the U.S. back in 1960. REITs are nothing more than publicly traded companies that own or finance income-producing real estate properties, including apartments, office buildings, shopping malls, even cell phone towers, and data centers. Deep Dive Investing co-founder Roger Conrad has been covering REITs for more than 30 years as editor of some of the largest and most successful income-focused financial publications in the U.S. Back in the 80s and 90s, when Roger first delved into the group, there was a ton of value in what was then a relatively obscure group. Just consider Mid-America Apartment Communities, a name we've recommended many times over the years, has generated a total return of more than 1,100% over the last 20 years, besting the S&P 500 by a nearly 4-to-1 margin. In 2000 and 2001, you could buy many U.S. REITs trading at close to book value, and the Bloomberg North American REIT Index offered a mouth-watering yield of more than 8%. However, over the years, institutional investors have piled into the REIT sector. Wall Street institutions have created a dizzying array of 45 exchange-traded funds and exchange-traded notes tracking the industry, all aimed squarely at yield-hungry investors. And when Standard & Poor's created the S&P 500 Real Estate Index, tens of billions of dollars worth of passive index money poured into the group virtually overnight. Warning, that's driven sector valuations, particularly in the largest and most widely held U.S. REITs, to nosebleed levels. With valuations so high, we believe many popular REITs are now actually very dangerous investments. The days of buying a broad, diversified basket of REITs and earning growing 8% yields with low risk are over. However, that doesn't mean there aren't bargains in the group. You see, Roger has developed a 4-part checklist to identify the best bargains in the group. This simple checklist pointed him and his loyal readers to the data center REITs back in early 2014. And this same process is guiding him to some incredible bargains today. I don't have time to go through all the details in this presentation. However, I want to give you access to Roger's detailed presentation on REITs, including his top high-yield, fast-growing REIT picks to buy right now, plus a rundown of some of the most dangerous and overvalued REITs you should sell before it's too late. Best of all, for a limited time, this detailed REIT strategy session and quick start executive summary is available with absolutely zero risk and no obligation only through this website. I want to show you how to reserve your copy here in just a moment. Today, I'm absolutely convinced we're entering the most profitable melt-up stage of this bull market, which will produce breathtaking gains for some stocks and market sectors. However, I must warn you, this is also the most dangerous stage of any market cycle. A time when some stocks will lag the broader market by a wide margin and could even lose you some serious cash as the broader market logs new highs. I want you to be in the right stocks and sectors to take full advantage of this cycle and avoid some very expensive pitfalls. In this letter, I've given you an overview of 5 profit trends my colleague Roger Conrad and I are recommending in our deep dive investing service right now. And I've shared with you the results of our years of comprehensive research on the economic and market cycles that drive returns for investors. I don't want you to miss out on this opportunity. And to help you profit from what I believe could be a dramatic rally, I'm going to do something I've never done before. For this service or any other service we publish, just give the work I've done a look. I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here until Tuesday, November 20th, with absolutely no risk or obligation. That's more than 2 months, more than 60 days, absolutely risk-free. If you decide at any time between now and November 20th that deep dive investing isn't for you, for any reason whatsoever, simply give us a call or drop us an email and we'll refund 100% of your subscription price. Absolutely zero ridiculous processing fees or restocking fees like some publishers out there charge. I guarantee it. And for the first time ever, for any service or newsletter we publish, we've decided to offer new trial memberships on a prorated basis. Simply put, should you decide at any time following your risk-free trial period that deep dive investing no longer meets your investment goals, we'll refund the unused portion of your subscription with no questions asked and no hard feelings. Simply click the Start Your Risk-Free Trial button below this video and let me know you'd like to take a trial subscription to deep dive investing today. I'll rush you a username and password for our secure website, granting you immediate access to all the detailed presentations and strategy sessions I've outlined in this report. plus concise executive summaries for all our themes and recommendations to help you get started profiting immediately. To my knowledge, there's no financial advisory service on the market today quite like Deep Dive Investing. We don't just scratch the surface of the themes, industries, and stocks we cover. In each issue, we want to give you a thorough understanding of the fundamentals that drive our big idea investment themes, so you will have the conviction to benefit from our best of the best ideas and recommendations. Roger and I attend industry conferences, participate in management conference calls, scrutinize financials, and leverage our contacts across the industry to track down the data, charts, and key fundamentals you need to make an informed, high-conviction buy or sell decision. And all our deep dive research is delivered to you in a novel and easily digestible format. Issues are delivered at least 20 times each year in the form of a detailed video presentation that includes a slide deck in convenient PDF format, packed with all the charts, financial data, valuation metrics, and background research you need to gain conviction and an understanding of our top ideas. And just to get you up to speed so you can act quickly on our recommendations, we publish a Just the Facts Please executive summary of our main conclusions and recommendations with each new issue. Roger and I have been discussing a service like this on and off for years, and we just launched Deep Dive Investing about 18 months ago to a very small group of beta testers. It's quickly become a hit with their readers, and we've decided to expand the service even further. Our new active total return portfolio is for investors looking to earn a positive return in any market environment through a combination of dividends and capital gains. It includes specific recommended allocations to a portfolio of stock recommendations, plus market hedges aimed at protecting your downside during market sell-offs and corrections. In short, we believe the total return portfolio will help you take advantage of the melt-up rally in the market today and protect your downside during the next bear market. For a strictly limited time, we're offering the service to new risk-free trial members at a discounted price of just $1,500 a year. And as I mentioned earlier in this letter, through midnight Eastern Time this Tuesday, September 18th, we're offering a small allocation of 30 annual prorated trial memberships. Plus, to make the decision to try Deep Dive Investing as much of a no-brainer as possible, I've decided to include one additional exclusive bonus. Start your risk-free trial to Deep Dive Investing today by clicking the button below this presentation. And I'll throw in a 1/4 subscription to our Energy and Income Advisor service. That's a $299 value, absolutely free of charge. Energy and Income Advisor covers all things energy, from high-yield MLPs to shale exploration and production companies and energy services firms. Energy is historically one of the best performing sectors in the final stages of a bull market, and oil prices are on the move right now. In short, we believe now is the time to start assembling a portfolio of energy stocks while the sector is still undervalued. I sincerely hope you'll join us today. I've given you my very best price offer and a risk nothing and keep everything guarantee. That means you have zero risk joining us. To get started, simply click the Start Your Risk-Free Trial button on this page, or give our customer service manager, Sherry, a call toll-free on 1-877-302-0749. That's 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday. Thanks for listening, and I look forward to welcoming you to Deep Dive Investing in the next few minutes. Here's to your wealth. To get started, simply click the Start Your Risk-Free Trial button on this page.